We're here to talk about the Silicon Valley real estate market analytics on June 22nd, 2004. We're going to go over 6 key indicators. That's going to be active inventory, offers accepted, days of unsold inventory, long typical seller time to market, seller price reductions, buyers overbids. Then we'll get into 3 weekly distributions. Those are the time to sell, sellers asking price reductions, and buyers overbids. Then we go into metrics of each one of these compared to the typical and hot and cold marketplaces. We then compare the 3 counties in Silicon Valley, Santa Clara, San Mateo, and Alameda with each other. We then get into 20 micro market areas covering the Silicon Valley. And then we wind up discussing the Greater Bay Area, 5 regions, 13 counties at the end. Here's the key indicators. These are my 6 leading indicators telling you what the market's doing. First is inventory. My inventory is different than almost everybody else's inventory in the fact that I do not count properties that are on the market looking for backup offers. Most people count those. To me, most agents don't show them, most buyers don't do them. They can't buy those properties until the first buyer relinquishes their contractual interest. So I exclude them from my inventory. What you have in this series of slides is the gray thin line here shows the normal trend, the typical trend. The red is the hot trend and the blue is the cold trend. The purple is the actual data. If you go back 13 weeks and you're inclusive, that ends up with 14 data points. And those are the 14 data points on here. And it's a moving quarter. It's not January 1st through March 31st. It passed 13 weeks in both bookends. We started at 1,500 listings and we're now at 2,500 listings. So we've gained 1,000 listings. And that's typical, but more than typical. You can see right here towards the beginning of the year, we had very limited inventory. We're almost down on the red hot marketplace. And now we're towards the typical marketplace. We're now at 91.7% of the inventory you'd expect, where 13, 14 weeks ago, we were at only 77%. Same concept with offers, but here the red line's on top because a lot of offers are a hot marketplace, where a lot of inventory is a cold marketplace. The orientation of the red and blue lines flip, but their meaning of them is the same. And this is offers that have been accepted in the past 5 weeks that haven't failed. You can see at the beginning part of the year, or beginning part of this moving quarter, we were below the lowest you'd expect it to be. We're now right at it. What does that mean in numbers? We were 67% of typical, so we were losing 33% of our volume. And now we're only losing 19.4% of our volume. We're doing better than we had been doing, but we're still lacking the buyers and we're not really lacking the inventory anymore. So that's very clearly not a supply constrained marketplace. Days unsold inventory is the balance between the buyers and the sellers. It's the supply demand ratio. And you can see I measure that in days of unsold inventory, basically somewhere from about 42 days and less is a hot seller's marketplace, from about 42 to about 77 is a balanced marketplace, and anything above 77 is a cold buyer's marketplace. And again, you can see we started the quarter, we were above the gray line. We were about a third of the way between the gray and the blue line. So a cool marketplace. Where are we now? We're basically almost in the same place. We're a little cooler though. I would say we're about 2/3 of the way between the gray line and the blue line. And the reason I put these lines on here, real estate is very cyclical, and you don't have flat horizontal lines where you're expecting 1,500 transactions, 1,500 offers all the time. It changes fairly dramatically during the year. So I'm comparing the same week to the same week. And my week starts on March 1st of every year because there's an extra day in every year except for leap year where there's 2 extra days. The discontinuity happens on March the 1st regardless because of leap year. So that's the base of my calendar year for doing statistics. I start on March 1st. I look back 5 weeks. I'm advanced 7 weeks at a time. I'm always comparing the same week to the same week. And time to sell, I look at the long typical seller. I don't look at the median or the average, both of which have a significant negative. This is basically the seller that doesn't price their home under to get offers right away. It's the seller that 3/4 of the sellers are selling in less than this time is what it boils down to. So I call it the long typical seller. And you can see that we started the quarter at a very hot marketplace. We were close to the red line, and we were still close to the red line. As it turns out, both at the beginning and at the end, that's 15 days to sell the long typical seller. So it's pretty quick marketplace for it's 3/4 of the sellers to sell in just essentially 2 weeks. Is pretty amazing, especially when most agents and most sellers hold their property on the market for about a week or so, regardless. So it's almost impossible to get faster than a week. Then we move on to price cuts. These are the price cuts the sellers do to attract the offers coming in. Yes, there are price reductions in pretty much every marketplace. And right now we started the quarter with 0.3% reduction. This is average. The vast majority of the sellers do their homework, price their home accordingly. It's not sellers taking very small price reductions. It's a very small percentage, 5, 10, 15% of the sellers, depending on the marketplace, that are taking those price reductions, and they're taking significant price reductions. And this 33% is actually 50% greater than it normally is, the amount of reductions. And we're basically taking 0.8% reduction, and the differential is only a third versus 50%. It's with 50% extra price reductions. It's about 21% to 33% would be about 50% increase. The typical decrease is about 0.2%. We were at a 0.3% for a 50% larger than normal discount. Now you're coming up here, and the discount is now only 0.3, 35%, 36% greater than it typically is, but it's greater at this time of the year. Look at this, it's almost 80%. It's not quite triple the amount of price reductions. What does that say? It says that the market normally potentially is slowing down at this time of the year. Sellers are used to the frenzy right after the beginning part of the year. Their expectations are higher, and they come on the market and they have to adjust their prices. So price reductions typically are much higher at this time of the year. And then flipping over, and this really isn't a lagging indicator, but it's a key indicator. It's the overbids, the buyer's overbids. This shows the offer competitiveness. And basically, we were overbidding 7.4%, which is 1.6% greater than normal. The normal overbid would have been about 5.8% over asking price, and now it's 7.4. You come fast forward to the end of the moving quarter, and now you're 2 percentage points higher, and you're at 9.4%, and that's typically 2.6% higher than it typically is. The normal number would be somewhere around 6.8 if I'm doing my math right. That's a recap. Each vertical line here is where the data points are. I try to line them up as best I can. And again, there's 14 data points. The far right is the current data point. This is basically 13 weeks ago. There's a total of 14 points as I bookend both sides. Now we're looking at the 3 key indicators: inventory in the purple, offers in the orange, and days of unsold inventory in the gray. Your inventory was down here. If you take the load time, basically the halfway through 2023, we're down to 60% of the inventory. There was a huge lack of inventory. And then we got up to roughly 80% on both sides. And now very recently, we've shot up from basically somewhere around 75%, and we're now at 92% of the inventory you'd expect. So we're only missing 8% of our total inventory. But look at your offers. Your offers really haven't changed that much. Yes, they were down at 70%, and they look like they're going to be at 80% now. But when you have 92% of the inventory and only 80% of the offers, your market is slower, and we measure that in days on unsold inventory. Here, a low number is a fast marketplace, and we're at about 116, maybe 117% of where you typically are. So the market is slower than it typically is for this time of the year. Yes, the market is fast paced, but it's typically faster paced at this time of the year. So now we're looking at the days on the market, and this is a distribution. Every line on here is a full week distribution, every transaction for the past 5 weeks. The purple dotted dashed line here is the current week, and the blue dotted dashed line underneath it is a year ago. You can see that the purple line is above the blue line, and that indicates that the market is actually a little bit slower this year it's taking sellers a little bit longer to sell their properties than it did last year. And the blue up here is the worst year we ever had. The red down here is the best year we have. So that gives you the range of which you can expect the data. We're going to start going a month at a time. And my month is either 4 or 5 weeks. And the data is actually the 21st because of my March 1st cutoff. I'm trying to keep as close to the 21st as I can. You can see there is some fluctuation because I'm using whole incremental weeks. I believe real estate is most heavily influenced by the weekly activity, and therefore all my data is based on weeks, not calendar months, as most people do. We start through, there's 11 months, 10 months ago, and you can see the line, it gets bolded. You can see the movement. Now it's starting to slow down in the end of last year. That's the bottom. Now it's going to accelerate. Look how big that acceleration was in a month. Now you're down in this little group down here. And that's about the peak of the marketplace there about 8 weeks ago, I think it was. So it's already slowing down, and now you're starting to having big slowdown. That's a pretty big step. Now a bigger step, another step, and there's the current data. Clearly, it's taking longer now to sell the properties than it was 8 weeks ago. That would be an indicating of a slowing marketplace. Moving on and looking at price reductions, this is the same concept where every line is a week. Up to the left is 100% of the sellers taking no price reduction. And basically we were there in 2022, which was Valentine's Day, February 14th, 2022. No sellers essentially were taking price reductions. Yes, there was probably a couple because I only go down to 2.5%, but less than 2.5% of the sellers were taking any price reduction at all. The worst one we had was back on December 27th of 2022. So basically, we went from the best marketplace to the worst marketplace in less than a year, basically 10 months. Again, here, the blue line is above the purple line. So the market now is cooler because down is cool. Again, we have sellers taking more price reductions this year than they did a year ago. And granted, it's not a whole lot. You can see that basically 15% of the sellers are doing all the price reductions. So that means 85% of the sellers currently are doing no price reductions, and the 2.5% of the sellers that are taking the biggest price reduction are taking an 11% reduction. That's how you can read this chart. We'll step through week by week, and you can see the market is fluctuating last year. Now it's going to slow down. And now it's going to start accelerating. Wow, look at that jump. And another big jump. And now you're going to be up at the plateau, sort of near the peak. The peak is going to come up right there's the peak. That was 8 weeks ago. And now you're cooling down. And you can see the step downs are fairly significant. And we're going to end up on the purple line, which is right down here, right there. Again, the market is cooler now with sellers taking bigger price reductions. Another way to look at this is basically somewhere right about here. So 10% of the sellers are taking a 4% price reduction. Now we're flipping over and looking at offers. This gives you the competitiveness of the marketplace. This is a lagging indicator because we need to get the closing price in order to plot whether it was above or below the sale price. But the concepts are the same. But now look at this. The last two slides that were leading indicators, the current purple line was doing worse than the blue a year ago line. In this case, the purple line is significantly above the blue line. The market is actually more competitive. Offers are more competitive this year than they were a year ago. And we'll step through starting off a year ago. You can see that you're now going to cool off for the end of the year. Slow down right there is the beginning of it. So right there is the sort of the bottom, middle of January. Then you start improving. The improvements are pretty major. Now you're going to be sort of at a plateau where you're going to go up a little bit, but pretty small amounts. There's sort of one peak. All four of those lines are about the same. Now it looks like to me it's coming down a little bit. And now it's definitely coming down. The competitiveness, the buyers are feeling less competition. They're not overbidding as much as they had been for about the last, what was it, maybe 6 weeks. So that's the first part of what we're doing. This has been the Silicon Valley Real Estate Market Analytics, June 22nd. We're going to end up, not right away, but we will end up covering the 13 counties in 5 regions covering the Northern California. The YouTube archive here is in the blue. I also, for people that want to do shorter typing, you can use the shortcut. My root URL is in green. If you add in 2024 to the end of the root URL, you get to the live presentation Saturday morning at 9 a.m. If you add in H, the year, month, date code, so H 2024-06-22, that gives you a 67-page PowerPoint slide presentation that we're going over. It is available if anyone wanted to get it and download it. I try to get it up about 15 minutes before I go live. And if you want any past episode, you put in the year, month, date code after the root URL. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information. I work with buyers or sellers here in Silicon Valley and have done so for a number of years. Please like or subscribe to the channel. That helps me out. And now we'll get back to the analytics. Here's looking at inventory. We're going to step through one by one of the major metrics and compare it to the typical marketplace, which is the gray line, which is where you'd expect it to be. A cool marketplace, which would be a lot of inventory, or a hot marketplace, which is a shortage of inventory. You can see that we're above 2,500 listings. I'd guess about 2,575. And typically you're somewhere up here about 2,850. So there's a little bit of a shortage, maybe about 10%. And I think that's what my numbers earlier said, about a 10% shortage. You can see that down here, basically at the beginning of the calendar quarter, the second quarter, we were pretty close to the red line. So we had a shortage of about 33%. You should have been about 2,000. You were about 1,500, about 500 listings short. 500 out of 2,000 is about 20% shortage, or 500 out of 15 is a 33%. It depends on how you want to look at it. Now you're a lot closer because you're about 2,550 versus somewhere around 2,850. So the shortage is only 300. It's less than 10% of the higher number. It all's how you look at it, but you can really see the inventory growing in the past calendar quarter. Each vertical line here is a quarter. The bolder ones are annuals. Prior to January 1st, 2023, the scale is more condensed so that we can go back to 2014. I will be adding one more year next year, so we'll be going back to 14, and this will become a little more condensed because I'm going to leave the current years out. I do one complete year so you can see the annual pattern and plus the year that we're currently in. Now what we do is we take that gray line on the previous graph and we stretch it out. And so here you can see that if you're down here below about 88% of inventory, I consider that to be a shortage in a hot marketplace. We're now above 90% of the expected inventory, so we're in the hotter side of a balanced marketplace. I shaded this versus put a red line in here because the red line would be jagged. Here's your typical marketplace on 100 because that is straightened out. Here it's just indicating it's a faster marketplace in a percentage. Up here would be a cooler marketplace. You can see in 2019 we're in a cool marketplace. Here's the pandemic announcement. I guess the pandemic announcement would be growth would be right about here. It's hard to really see it on inventory. Inventory really didn't change because sellers weren't listing their properties and they weren't going off the MLS. But you can see the huge shortage that we ran into at the beginning of 2022. And then you can see the inventory growing in 2022 as we got into that price adjustments. Here's looking at this offers accepted. You can see that the offers were even below the blue line for the first quarter of 2024. Basically, the second quarter of 2024, which is about to end, it's been very close to the blue line, but slightly above. So you're having slightly more offers than the least number that you would expect. And where you'd expect to be is up here. So you'd be expecting to have somewhere around 2,800 offers, and we're only having somewhere around 2,300. So there's a shortage of about 500 offers, and that's every 5 weeks. We're losing about 100 transactions each week. Here's the same concept where we take that gray line and stretch it out. So at 80%, you're definitely in a cool marketplace. It looks like here I changed it at about 95% and at about 105%. And you can see that until the pandemic, all the data was fairly close to 100%. which is why these are tight. And that here you can see the huge drop off in the number of offers as buyers just froze. And in fact, for a while, we weren't even allowed to show properties, and then we could show vacant properties, and finally we could show all properties. And then you can see the impact after the pandemic where everybody's housing needs changed. We had this huge surplus of offers and transactions following the pandemic. Here's your days of unsold inventory. Here you can see the gray line, we're above it, so that's a cooler marketplace. We're about halfway between the typical marketplace where you'd expect it to be and the slowest you'd expect the market to be. So we are in a slower than typical marketplace, even though the market remains fast. In other words, the slowest marketplace would be up here about 47 days, which is still a fairly aggressive marketplace. So it's a slow marketplace compared to where the market normally is, but it's still fast paced. Right now, you're down at below 40, which is clearly a seller's marketplace, even though, again, it's slower than typical. Here you take the same concept, gray line stretched out, and here you can see that it's slower. You're up here or somewhere around 116, 117% of the days unsold inventory. The higher the days unsold inventory, the slower the marketplace. Here's the marketing time. This is the slide for the consumer that doesn't like statistics. How long is it taking the long typical seller to sell? So 3/4 of your sellers are selling in 15 days, and that's really the fastest you'd expect the market to be, but you'd only expect it to be up here at 17. So there's only a 2-day fluctuation. And now here's the same concept. So you're at 90% of where you'd expect it to be. So you're selling a little bit faster. You'd expect to be right on the gray line, and then a cool marketplace would be great longer than expected. Here's seller's ask price. So 0% would be no price reduction at all. And you can see the red line is indicating a small price reduction. It's typical for even in a hot marketplace for sellers to do a price reduction. Now, granted, in the very hottest marketplace I've seen in 2022, and we also had it back in 2018, sellers were actually on average raising their asking price. Very unusual, but it does happen. And again, the gray line is where you'd expect the market to be. And we were basically there at the end of last quarter, first couple weeks of this quarter, we were right there. And now you're down a little bit, and it's the vertical, not the horizontal. It's the vertical separation. And you know, it's when you're falling this quickly on the blue line, it's hard to tell how close you really are to the blue line. Your eye wants to go diagonally over and say, oh, we're real close. But you have to go straight vertically down, and that's down here somewhere here. The vertical separation is still actually fairly significant. Here's the same concept. We're pulling it out. So here, a hot marketplace is even with sellers taking about 1/4% price reduction. And then a cool marketplace starts when they're taking 0.75% price reduction. Again, a very tight metric. You can see before we had the pandemic impact, you know, you were basically a lot of time right in that white. Then we had a slowdown before the pandemic. We had the pandemic, we had the recovery, and then we had the 2022 correction. And look at that huge drop down here. The sellers were expecting the market to be up here. The market was down here, and they had to do large price reductions. Then all of a sudden in 2023, the market recovered, and basically it's been doing about the same, but still sellers taking more price reductions than they typically do. Here's the frequency of the ask price. So that was the magnitude. Now we're looking at the frequency. How common is it for sellers to do price reductions? And here you're pretty darn close to the gray line. The red line would be fewer sellers taking price reductions. The blue line would be the most sellers taking price reductions. And again, the purple line is the data, which is just about on the gray typical line. You can see that you're a little bit above, so a little bit on the slow side, but you're pretty close. You're basically something like 104%, so 4% more frequent. Here's the average overbid. So now we're flipping over and looking at what the buyers are doing. This is the competitiveness of the buyers. But again, this is a lagging indicator. You can see that the purple is sort of following the shape of the red line, but it's clearly below the red line. But you have more overbidding than you typically do. We started off the year right at typical. And then we shot up right here, basically about halfway through first quarter. And now for the last, I guess it would be quarter and a half almost, buyers have been overbidding more than typical. And it looks like, well, they'll be doing that, but they're coming clearly down because just a couple weeks ago, they were at 8% overbidding. They're racing towards 6% overbidding. Here's the frequency. Here's the typical. You can see you got up there where you were above the normal typical. Here, what is that, about 3%? The typical overbidding was about 5%. The actual overbidding was about 8%, so it was 3% above, and you can see we're back down now. So we're now only overbidding about 1.6% overbids above where you typically overbid for Silicon Valley. This is the frequency of overbidding, so it's a little bit more common, which helps explain why the magnitude is higher, because when you're looking at more people overbidding, there's less people underbidding, and that raises up the over average. But again, you can see it rolled over and it's cooling off a little bit. Same concept. You stretch out the line, and here, it's sort of interesting. We've cooled off a little bit, but it would almost indicate here that I misread the previous graph a little bit because that's close to being a flat indicator. Here's your long-term appreciation on long log paper. This is sort of a freehand rate of appreciation, and you can see at the end of every year, you do this huge V down and then you recover. We're basically at the peak of the pricing for the year. You can see that it's been pretty flat, and you come back and it's flat and it starts going down. And again, these are the offers that were negotiated 4, 5, 6 weeks ago, so it's a lagging indicator. Here's the payments that people would pay based on the current sale price and the current interest rate. Obviously, there's a little bit of a lag time because I'm using current interest rates with sales prices that were 5 weeks ago, but it gives you an idea what the payments would be for the typical property. This is the cheapest 10% in Silicon Valley. This is the typical median in Silicon Valley at about 13.5. And this is the most expensive 90 percentile property. This is impacted not only by the sold price of those percentages, but by the interest rates, which again came down last week a little bit. Here's the number of offers that have been accepted, so you can see the raw tables. And basically, we've been doing a lack of inventory, but because I go back and update my data based on TFTs and all those things, we've now only been the 8th slowest year out of the last 10 or the 23rd slowest out of the last 25. So this becomes somewhat less significant, but still, if only 2 years did less than you, and one of them was the pandemic and one of them was last year, you're still having a fairly slow year. And that's what we've seen. Offers below where you'd expect them to be. Here's looking at active inventory. Now what we're doing is we're comparing the 3 counties, Santa Clara County in the blue, Alameda County in the gray, and San Mateo County is in the orange. I would say San Mateo County has basically their normal inventory. If you go back to looking here, Santa Clara is basically lagging behind because you can see where they typically are up here before we got into the pandemic mess. And Alameda County is still climbing, but also doing a better job of recovering inventory than Santa Clara County. Here's offers accepted. Santa Clara County is selling more homes. So Santa Clara County is selling more homes and has less inventory than Alameda County. It's going to be a faster paced marketplace. San Mateo County is actually probably a little bit lower than it would be expected on offers, which means the market would also be a little slower. Here's your days of unsold inventory. So Santa Clara, as sort of predicted, is at 32. The fastest, San Mateo is the second at 40. If you go back here, San Mateo County is normally lower than Santa Clara. So this is a role reversal that happened basically with the pandemic, and Alameda County is the slowest out of the 3 counties. Here's marketing time. Santa Clara County is the fastest at about 17 days. Alameda and San Mateo County look like they're identical at 21 days for 3/4 of the sellers to successfully sell. That's 3 weeks. Santa Clara is basically doing it a little over 2 weeks, and the other 2 are in 3 weeks. This is the magnitude of price reductions. San Mateo County is doing the biggest price reductions at about 1.25%. Alameda County is second at about, I'll call about 85% maybe. And Santa Clara County is doing only about 0.6% reduction. And that's on average. again, I've said it many times, it's a few sellers taking very large price reductions. This is the frequency. In Santa Clara County, it's only 13% of the sellers are doing price reductions. And in San Mateo County, where it's the most common, it's only 15%. So less than 1 in 7 sellers have time to reduce their price. Here's the overbidding. You can see that San Mateo County has the least. Santa Clara is right there. And surprisingly, Alameda County has the most overbidding. Alameda County is a slower county right now, and it might have been the slowest, and yet it's got the most overbidding, sort of not what you would typically expect. This is the frequency of overbidding. Alameda County has the most overbidding, followed by Santa Clara, and San Mateo County has the least overbidding. Here's the appreciation since the last 9 months of 2015. Santa Clara County's had the most appreciation at about 205%, followed by San Mateo County at about 190%. And that's 90% appreciation. This would be about 105% appreciation. And Alameda County has the least appreciation at 82%. Here's the sold price. Look at the dip the last couple weeks up here. Santa Clara County is now basically right at its previous peak. San Mateo County is slightly below, and Alameda County is significantly below, but only for a short period of time. Here's the same on regular paper for those that prefer. Here's the estimated payments for the 3 counties. Alameda County is the most affordable. San Mateo County is the most expensive, and Santa Clara is in between. Here's the actual data for the 3 counties. You can pick whatever metric and county you're interested in. Here are my heat maps showing the active inventory. Red shows a lack of inventory, and blue shows a surplus of inventory. This is offers accepted. Now it's reversed. Blue shows a lack of offers. There's not as many offers as we expect, and you can see that's true across the entire Silicon Valley. This is the speed of the marketplace, so slower or normal, depending on what area you're looking at. This is days on sold inventory. Even though we're in a slow marketplace, based on just the raw counts, this is fairly fast paced, except for when you get into the expensive areas in San Mateo County, the San Mateo County coast, and in Oakland. Everybody else is basically a fast paced marketplace, even though it's slower than it typically is. This is the time for 75% of the sellers to sell. The slowest area is the San Mateo County coast, followed by the expensive areas. But again, almost all these areas are selling in under 3 weeks, which is a fairly fast-paced marketplace. Here's the seller ask price adjustments. You can see the numbers are pretty small. The coast is 4% price reductions. That's actually sounds small, but it's pretty significant. Here's the frequency of those price reductions. We're almost 41% of the sellers on the San Mateo County coast have reduced their price to entice the offer to come in. Here's the magnitude of overbidding. You can see it's pretty high. It's running from about 2% up to about 22% in Berkeley. If you eliminate Berkeley, it's then 12% in Oakland, and then 8% or 10% in Fremont. Frequency of overbidding, you can see that basically around 75 to 90% of the sellers are getting more than their asking price. That's why it's so red. Here's the long-term appreciation. Blue is less appreciation. The least amount of appreciation was just under 50%. The median appreciation is 91%, and the most appreciation was 103. So from the median to the peak was fairly tight, but from the median to the lowest is a large area. Here's your sold price range. In addition to just the middle number of the median, I show the 10 percentile and the 90 percentile. So you're sandwiched in each one of the micro market areas. Here's a summary. You can start with the micro market area on the left, or your affordability either in monthly payments or in total loan amounts, and then see what the market conditions you'd experience. Moving on and talking about the Greater Bay Area, that's 5 regions, 13 counties. The first region is Silicon Valley that we've just been talking about, Santa Clara, San Mateo, and Alameda County. Then we add in San Francisco and Marin as the cities. Then we add in North Bay, 4 counties, and Sonoma, Napa, Solano, Contra Costa. We add in the Central Valley, San Joaquin and Sacramento, and then the Central Coast being Santa Cruz and Monterey. Again, this is single family detached and duet homes. Here, starting off in the reverse order, is the different counties down on the left-hand margin, the different metrics across the top. You can look at whatever metric is most important for you. Here is the inventory. This is comparing the inventory for the 5 regions. you can see that everybody is down from their previous levels. The Central Valley is probably down the most because it was way up here along with North Bay. And now North Bay is a little bit higher than the Central Valley, but they're down the most. Silicon Valley is getting close to the normal levels of inventory. You can see that we're right here. We're still definitely on the low side, except for the years right after the pandemic when there was a shortage, but we're not so short that we're limiting the number of transactions based on lack of inventory. And Central Coast and the cities are also off, but not off as a large percentage as the Central Valley would be my estimation. Here's looking at the number of offers. You can see Silicon Valley actually has the most offers out of all the areas, and it typically has. It's typically, the purple line is typically on the top, and it's now on the top by more. So Silicon Valley is doing better than the North Bay or the Central Valley. And then because they're smaller in size, Central Coast and San Mateo County down here. And San Mateo County looks like it's doing a little bit better than the Central Coast. Historically, the two are right on top of one another. Right now, the Central Coast is lagging behind. Here's the days of unsold inventory. This is the supply-demand ratio. The area that's the fastest is Silicon Valley in the purple, followed by the cities. The slowest is the Central Coast. And that's probably the real takeaway. The Central Coast is the slowest and typically is. You can look back in time and see that the blue line's almost always on the top and the purple line's always on the bottom. That gives you a strong indication that each region has its own market. So you can't talk about national real estate. You can't talk about Bay Area real estate. That's why I broke down Silicon Valley into 20 micro market areas. Here's your marketing time. Silicon Valley is the fastest. Now the Central Coast, even though it had the slowest DUI, it's actually right in the middle of the pack for time for the sellers to sell. And the North Bay is the longest time. And this is time to sell is the length of time it takes 75% of the sellers to sell. And even in the slowest area being the North Bay, you're basically at about 33 days. So call it a month. For 3/4 of all sellers to sell their property within a month, that is still a fast-paced marketplace. Here's price reductions. Now keep in mind, some sellers do their homework. They price their home where they expect it to sell. Some sellers even price their home artificially low to get multiple bids in. The average is a very tight metric. There's not a lot of fluctuation. You can see that the Central Valley and Silicon Valley are together up here with less than 1% reduction. That does not mean that the sellers that are taking price reductions are taking 1% and 2% price reductions. It turns out it means that 10% of the marketplace is taking roughly a 10% price adjustment downward. That works out to an average of 1% reduction, that kind of thing. When we look in the numbers, which is coming up, the frequency, you'll see that it's a very low frequency. The area that's doing the most price reductions is the Central Coast. Here's the frequency that I've talked about. Silicon Valley, somewhere around 13% of the sellers are doing price adjustments. That means 87% of the sellers are doing no price adjustments at all. And even up here in the Central Valley where you're having the most adjustments, it's only 26%. So only 1 out of 4 sellers are doing a price adjustment. That means if it was uniform at 25%, whatever the reduction is in the Central Valley, and we'll call it 1%, that means the sellers that are doing price reductions are averaging 4% price reductions because only 1 in 4 sellers reducing it. So that would average out to a 1% reduction. So it's a very small number taking significant price reductions that gives you a small average price reduction. Now this is like flipping over and lagging because we need the sale price. You can see Silicon Valley rolled over first, but almost all the regions are rolling over. The exception is the Central Coast, which actually looks like it's picking up. So again, each area is going to have its own marketplace that's different. You can see that, you know, the peaks are close, but slightly different here. And I think if you came down, you would see it almost looks like the Central Valley down here was the first one in 2022 to roll over and start coming down. But they all came down within about a 4 or 5 week period of time. Here's the frequency of overbidding. So where it's the most overbidding, Silicon Valley with almost 80%. It's about 76.5% of the sellers are getting over their asking price, followed by the cities at somewhere around 67%. Then you drop down to North Bay at somewhere around 53%. Central Valley is about 51.5%, and Central Coast is under 50% at about 45.5% of the sellers getting more than their asking price. Here's the total appreciation, and the big takeaway here is look at the cities. It's now at the bottom. Come back here before the pandemic, it was basically in the mix. Silicon Valley tends to be on the high side of the mix. Silicon Valley is the highest now. Cities is absolutely the lowest and negatively impacted by the pandemic. North Bay is second, and the Central Valley and the Central Coast are neck and neck. Here's the sold price. So the cities and Silicon Valley are neck and neck. This actually looks like Silicon Valley is outpacing the cities by just a tad on the median sold price. Then you have the Central Coast, North Bay, and the Central Valley being the least expensive area. You can see the cities is still quite a bit below their previous peak back in 2022. Here's the payments, going to be in the same order. This is showing what the monthly payments are, assuming an 80% loan, 30-year fixed, using the national interest rate. And with that, we've gone through. I'll see if anyone has any questions. Not seeing any unmuted mics. Have a great week, everybody. Bye for now.